Thank you for tuning into Astor Investment Management's podcast series. This week, our Chief Investment Officer, John Eckstein, and Senior Managing Director, Mac O'Brien, discuss the current economic outlook in the era of COVID-19. Thank you both for joining us today.
Hello, everybody, and welcome back to another week of Astor's Economic Week in Review. Again, Mac O'Brien here with John Eckstein. John, how are you doing?
Mac, I'm doing great. Nice to be on a Zoom room with you.
Awesome to see you too. Sabila, again, thank you for the introduction. So to start our podcast, we usually like to give a little bit of a summary of what we're going to be talking about. So the data points that we have today are, John, jobless claims.
Yeah, we got jobless claims. We got PMI, the Purchasing Managers Indexes. We've got the first quarter GDP number. And I want to make a point about the personal income number, which we usually wouldn't talk about.
Right. I think we're also going to talk about different ways that you can trade the oil markets right now. That was a question we had from one of our listeners.
We did. And I think we also want to hit on where the Fed meeting this week and where the Fed is.
All right, perfect. So we usually start with jobless claims. Do you want to hop into jobless claims first?
Yeah, so claims were another very disappointing number, 3.8 million, and the number is going down a little bit month by month, or week by week, excuse me. So at this point, we've lost more jobs. If you just sum up the number of new claims, that number is bigger than for the whole financial crisis, 2008, 2009.
Right.
The continuing claims number, that is the number of people who are actually receiving the unemployment, is a little bit lower. And that brings up an interesting point. So right now, if you look at how many people have filed for benefits in the United States, this is before the last number, it was about 17% of people had filed for benefits, but only 11% of people were receiving benefits. So there's two things to point out about that. One, 17% of people have filed for benefits. That's insane, right? 70% of the U.S. labor force, yes.
Wow.
And those are like Depression-era numbers. But only 11% have actually been receiving the benefits.
Right.
So, and there might be lags in here. There's people who might be filing twice somehow because they're not getting through. And there might be people who are getting rejected by accident. So we don't know. But that, not all of the money has gotten to people, and that situation is still working itself out. A lot of states made it more difficult to get unemployment insurance. And so they're having to sort of undo all of those roadblocks they put in the way. And that's like everybody's scrambling to make it work. Now, some more cheerful news about claims is that, so somebody does a survey of people applying for unemployment claims, like, do you expect to be hired back or not? And usually that number is like 40%. People get furloughed for various reasons. But now in California, at least, that number is 90%. So 90% of people expect that they're going to get hired back. We'll see if that happens, right? But that's a much bigger expectation.
John, the question I guess the comment I'm going to make is, when you read about jobless claims or you listen to the talking heads on TV, it's always, they paint a pretty picture that jobless claims, although it's a big number, it's trending down. And for me, I just don't see the slope of the downtrend to be significant enough to give me any good feelings of optimism. And you're still having 3.8 million people, which is a multiple of what was the worst week ever before this ever occurred, right? I mean, we said the worst week ever was in the 80s. And what was that? We talked about,
I think it was 600 or something.
600,000, right? So we are 5-6 times that, and we're trying to paint a pretty picture about it when, in the height of the financial crisis, was the worst week was like 600,000 or 400,000 or something like that. So I just feel like the slope isn't significant enough in the decrease in order for us to say, okay, things are getting better, right? It's still just astronomical numbers on a week by week basis.
Yeah, the numbers are still extremely high, and at some point, everybody who qualifies for unemployment insurance might have filed, right? We'll have to watch and see what's going on, and it'll be more informative. And I think also, I think what probably happened is that 20 million people wanted to file in the first week, and it's a lot of this is states dealing with backlogs and stuff like that. It's hard to say if this is really reflecting things getting worse or not, or still, continuing to deteriorate, or whether this is sort of catch up.
Something you said that you want to talk about today, John, that I think is somewhat of a segue into people losing their jobs, is personal income, and specifically the savings rate that comes out with that. So talk to me a little bit about that.
Yeah, so this is so again, we're going to talk about timeliness, right? So this is a little bit of a stale numbers from March, but still the savings rate as a percentage of disposable income, so it's usually the last 10 years or so, it's been, let's say about 8%. It was 13%, so it was much higher. And again, this is still a March number, so before everything really started getting thoroughly locked down. Just another example of what's going on with precautionary savings for
So do you
people.
think that's precautionary savings, John, or do you think that is people just don't have stuff to spend money on, so they're saving more?
I think it's both. And actually, one thing that's really interesting is that I saw some numbers out of the UK and Sweden that were saying the slowdown in spending in recessions usually hits rich people less, but this time richer and older people are the core of the slowdown in spending. That's interesting. If that turns out to be the case here, that's sort of evidence maybe for the build-up theory, right? Like where people are storing up and now they're going to go crazy once the lockdowns are lifted. And
I'd be interested. I mean, personally, for me, we're spending less without a question. And we're looking at some purchases that we've been putting off, some larger purchases. And we're like, okay, we can let's make those purchases. Let's start doing our research on what we want to buy because we had that extra income. So we haven't spent it yet, but we are looking at certain things that we've been talking about for a little while to see if we can now make that happen.
Yeah, I'll say anecdotally, my buddy's car spontaneously combusted. Like a car that's like 10 months old, like a new car, just like caught on fire and burnt down. And so he bought a new car last month and he got a great deal, right? He got below dealer invoice. I don't know if you think about getting a car, and the car sales are coming out today. They're trickling out today and they're going to be, they're terrible, down 30%.
How does a car spontaneously combust, John?
That's for my my other podcast, Spontaneous Combustion and You. So you'll have to tune into that.
Weird insurance rules. But anyways, let's move on. So PMI, let's talk about manufacturing. Overall, all the data that we're going to talk about this week came in bad. Some data, the higher the number, the better, some the lower. But across the board, all the data missed expectations. PMI actually was the best data point. But we're talking about PMI manufacturing.
Yeah, I mean, again, like the expectation, this is such an unusual period. The expectations aren't as good of a guide as they are sometimes. But yeah, so the PMI came out at around 41, which means that they asked people is things better or worse than they were last month. And 40% of people said overall things are better. So now there's some funky things about the PMI number. Like one of the things that makes the PMI number better is if you've got slower deliveries from your suppliers.
Right.
So like the idea being that, if I'm, making cookies and the flour is not coming in and that's probably because the flour company is just overwhelmed with orders and it's just slower. In this case, that's not the case, right? Like might not be the right way to interpret it. So one thing you could do is look at the employment subindex, which looks at manufacturing, are you increasing or decreasing employment? And only 27% of companies say that they're increasing employment. We could probably name those companies off the top of our heads, right?
Right.
The specifics of the number, it's better that the number's higher, I guess, but it might not be showing the whole reality. Also, if you look at, there's another manufacturing PMI number by market, and that is a little bit lower. But the important thing is that both of those numbers are substantially below their lowest point in the global financial crisis.
Yeah, I mean, I read that if you throw out supplier deliveries in the ISM manufacturing that came in at 41, like you said, if you throw out supplier deliveries, the ISM's in the 20s. I mean, has it ever? I mean, that's.
I'm not sure. I'm not sure about that. I thought it was only a couple points. I would have to work it out the math myself. But I think my takeaway from the PMI numbers is that both the manufacturing PMI numbers are at their low point as during the global financial crisis.
Right.
So again, like the question we're going to be looking at is the bounce back. How steep is the bounce back going to be?
Right. And I have my own opinions that I will keep to myself for the time being. I just don't feel like it's going to be as sharp as people think it's going to be. I think it's going to be a little more U-shaped than V-shaped, but we will see.
We will see.
All right, John. So manufacturing is a component, obviously, in the gross domestic product that came out to a dismal, like a -4, was it? Officially, we're in a recession?
Yeah. So -4.
0.8, yeah, -4.8.
The one thing that's interesting about this is that half of that decline is due to healthcare, which might surprise people. But basically, that's a combination of hospitals not doing elective surgeries, which pays for their bills, and people just not going to the doctor. If you had a doctor's appointment, if you had a checkup this week, you would have put it off. So remarkably, the healthcare was a significant part of that. Also, the services, this isn't a final number, and this is subject to large revisions, and the services for March in particular are going to be revised. So this number, sort of take it with a grain of salt, but sharp decline in investment and consumption, the government not really making up for that much of it.
Yeah, John, going back to healthcare real quick, and we talk about, first, second, and third order effects. The second order effect is, you gave the example last week that if the restaurant comes back and they have 33% of tables, then the dish company that supports that restaurant, they go out of business, right? Or they have to lay people off because they're not as busy. And in the healthcare, what people don't realize is a lot of these doctors are entrepreneurs, and they have their own buildings, they have their own staff. They are,
right, and they owe the mortgage, whether or not they're getting clients, right?
Yeah, and the equipment. I mean, the equipment themselves are sometimes more expensive than the mortgage, right? I have a friend who is a really good hip and knee surgeon, another friend who's a foot surgeon, another friend who's a dermatologist, and they are legitimately concerned for their businesses, and they may have to at some point. Bankruptcy is an aggressive word, but it is a severe concern that they built these businesses and they go to school thinking that the doctor and their MD or the DO are insurance policies that will get them to provide for the families regardless of what happens. But I mean, people aren't going to the doctor. I have a 4-month-old, and we went to the 4-month-old checkup, and the pediatrician was saying how scared she is, right? She said, I am legitimately scared for my business. I mean, people don't realize how many doctors and health companies are going to be severely pressured throughout this downturn.
Yeah, I mean, the concern is that that's one illustration. There's lots of areas that is going to be true. And, especially sort of sole proprietorships don't have a lot of savings to fall back on. So we're going to see how that works out in healthcare and a lot of other areas.
Yeah, absolutely. So John, that's GDP. Obviously, we're in a recession. We'll see how deep it is, and we'll watch the GDP numbers moving forward. The Fed came out this week, right? Unchanged between 0 and 0.25 point. Between the lines of what's going on with the Fed, they say they still have tools to support the economy. Where we're going with the Fed, I mean, they say don't fight the Fed, and that's been true the past couple of weeks. But to a point, you can only do so much, and the demand has to pick up. You can't buy demand with liquidity in the markets.
Yeah, they definitely still have tools. One of the tools they have left is sort of explicit forward guidance, which is where they say, we're going to keep rates low, for a year. They sort of went halfway there in their outlook, saying they think the risks are to the downside for the medium term. And for a central banker to say that, I think that's code for, we're not quite getting to forward guidance yet, but we're getting close. And nobody's talking about cutting off the programs. Nobody's talking about exit strategies. It's going to be months and months and months before we do that. And I think the Fed is looking at the same numbers that a lot of us are and wondering if, we're going to turn this lockdown into a recession sort of on top of the lockdown. So we've got impulse shock from the lockdown, right? And stuff goes down and then it goes back up. But what if it goes down so much that it causes a recession on top of that? And I think that's what the Fed is looking at.
Yeah, and at Astor, we talk a lot about what causes recessions, which we're in right now. And we see when the economy is less healthy and stuff happens, right? Whether it's a trade war or the terrorist attack, or in this case, a pandemic, the likelihood of the severity of the recession or the impact of that external event, that negative event, is exaggerated by the health of the economy. And we always say that people seem to be singularly focused on the coronavirus right now and the impact, but we're forgetting that we're not immune to something else coming. The coronavirus is in a vacuum by itself, but we still have a volatile election cycle coming up. We still have instability in the Middle East. We still have an energy crisis happening right now. So when you said the downside, that the Fed is saying that the risk is in the downside, that made me kind of think of the other things that are out there, right, that we're not talking about because all the news is focused solely on COVID right now.
Yeah. And like, what sort of recovery are we going to be able to patch together? And, it's also, when the government says that you're going to go back to work, like we were saying last week, like if they open the movie theaters, you probably wouldn't go. We're going to see what's happening in these states that are opening up early, how much their economic activity actually does improve. And the first day the first week isn't the best way to think about that. We'll have to wait for several weeks, people getting used to it. But
yeah, you have the brave people who don't think this is a big deal. The first couple of weeks, they'll go in droves, and then all of a sudden, that demand will taper off, and we'll see the real demand for the states that are opening up.
Yeah, and states are also, at least New York is talking about, what their rules are going to be for opening up in terms of, monitoring reproduction rate of the virus and monitoring hospital usage. And, we'll see if we get second waves and second periods of lockdown too.
Great. Okay. So, John, we were going to talk today about what's really different about this crisis relative to past crises, but we're coming up on our time crunch here. So let's move on to the oil markets. We had some questions from our listeners about how to trade these oil markets, what to buy. With that being said, what should an investor look at without giving, strong recommendations?
We're definitely we're not giving investment advice here. We're unambiguously not giving investment advice or legal advice, any advice. We're just talking.
So oil market, ETFs, what's out there?
Yeah, so I think the important thing to remember is that there isn't a way for a retail investor to buy a bunch of oil that's sitting in a tanker somewhere and hope for the price of oil goes up and then you sell it in the future, right? That's not what you get to do. Like what a retail investor can do is basically get an oil future or specifically get a share of a ETF that owns oil futures, and those are subject to different sort of risks. We talked last week a little bit about, how the oil went negative for a minute, and that all has to do with sort of technicalities of the oil delivery. And so the two main oil products that we've looked at Astor would be one called USO and one called DBE. And those are becoming actually more similar. So I think a week ago, they had a little bit of a starker difference where DBE has a whole range of energy products. So it doesn't have only oil, but it's got gasoline and it's got oil for delivery in Europe and it's got heating oil and it's got natural gas. So that's like a more of an energy complex bet. And USO has traditionally been just front month oil futures.
Got it.
USO is the one that ran into all the problems. If you're thinking about buying USO, you just have to make sure you look at their website because they're changing what they do basically every day. It's almost like a real-time thing. Like they're changing what they're investing in. And so now they're investing in a broader range of things. They're investing in different months. And so just sort of, this is definitely a buyer beware sort of thing where you want to keep your eye on the ETF is actually doing. And I think DBE has been much more stable in terms of its goals than USO. And the other thing to bear in mind, again, is, as I started with, like you're not actually buying a big pot of oil somewhere, right? You're buying a financial instrument. And the financial instrument, like the way the futures curves are shaped now, you're expected to lose money for reasons that are a little bit complicated, but they're sort of, the futures curves are downward sloping. And so you expect to lose a little bit of money on them. And so just be careful and do your homework before you buy one of these is what I would say.
Good advice. I don't have much to add on the intricacies of oil futures or oil ETFs. So with that, let's wrap it up, John. Next week, we have some interesting, of course, data. Let me see here. Next week, we have motor vehicle sales, which you talked about your friend burning his car down. ISM non-manufacturing, which, I mean, what percentage of our economy is service? Did I read it's like 70% of our economy is service oriented? It's
closer to 90, actually. So it's more like, 85 or.
That's wild.
80.
What was it 30 years ago? It was inverse, right?
No, it was inverse in the 20s. It's been a predominantly service economy for a long time,
right.
But manufacturing has historically gotten more focused because it's where the business cycle would typically happen.
Right.
Usually the business cycle happens in manufacturing and then it spreads to services. We'll see if that happens this time.
Yeah. So non-manufacturing or the service side of the economy we'll look at next week. Jobless claims, of course, again, and the employment situation, which is one of the biggest data points that Astor reviews. It's when our investment committee meets. So big week of data next week. What else on the higher frequency side is coming next week, John?
Yeah, all the high frequency stuff that we're looking at comes out every week. That's why it's high frequency. And so it's all still negative. Maybe we'll talk about that more next week. I want to say, so right now the surveys say a 16% unemployment rate is what they're forecasting. We'll see.
Sounds great. Everyone, thanks for listening. John, as always, thanks for your time. Have a great weekend. We got 75, 76 degrees and sunny. So we'll see how this stay-at-home order works out in Illinois over the weekend with 75 and sunny out.
Well, get some air. Talk to you soon.
You got it. See you, John.
To learn more about Astor Investment Management's research and strategies, please visit us on the web at www.astoram.com or stay up to date by following us on LinkedIn, Twitter, and our app is also available on the App Store and Google Play. Thank you. Astor Investment Management, LLC is a SEC-registered investment advisor. All information contained herein is for informational purposes only. This is not a solicitation to offer investment advice or services in any state where to do so would be unlawful. Analysis and research are provided for informational purposes only, not for trading or investing purposes. All opinions expressed are as of the date of publication and subject to change. They are not intended as investment recommendations.